Welcome to the Opening Bell Report.
We're talking about rockets, legacy fighter jets, and the kind of stock market volatility that keeps day traders awake at night. The big headline we are tackling for you today, FJET stock explodes 16%. Is the small cap space rally back?
Yeah, and for anyone holding momentum stocks or just tracking the broader commercial space economy, the underlying data in this analysis report provides a fascinating look at how speculative capital behaves in real time.
It's wild to watch.
It is. We're going to look really closely at the collision between thrilling technical price action and the rather unforgiving reality of a corporate balance sheet.
Okay, so let's unpack this. We are specifically looking at Starfighters Space Inc., trading under the ticker FJET on the NYSE American Exchange.
FJE.
Exactly. And to give you some context, this company has been enduring a brutal post-IPO slump. The stock was heavily beaten down for months.
Completely languishing.
Yeah. Then, seemingly out of nowhere, it roared back to life in a single trading session. We need to figure out if this is the start of a legitimate sector-wide recovery, or if we are just looking at a fleeting dead cat bounce before the stock resumes its downward trend.
And the timeline of that breakout day is the perfect place to start, because it illustrates the sheer mechanics of modern retail trading.
So the opening bell rings, and FJET starts the day at $6.59. Within hours, it catches a massive, undeniable wave of buy volume.
Huge volume.
The data shows this surge pushed the stock price straight through its 5-day and 50-day moving averages. It didn't just test those resistance levels, it blew right past them.
Right past them.
It hit an intraday peak of $8.46. It eventually cooled off slightly to close at $7.78, locking in that massive 16.21% gain. So what actually happens behind the scenes when a stock breaks through those specific moving averages so violently?
Well, what's fascinating here is that it triggers a cascade of algorithmic buying. When a stock is languishing in a post-IPO slump, quantitative trading models and momentum algorithms largely ignore it.
They just screen it out.
Exactly.
Right.
But the moment retail volume pushes a stock past its 5-day moving average, it signals hyper-immediate short-term momentum. And when it simultaneously crashes through the 50-day moving average.
That's the medium-term trend shifting.
You got it. Algorithmic trading programs are hard-coded to look for those exact crossovers accompanied by high volume. Once those levels are breached, the algorithms automatically initiate buy orders.
Which just creates a self-fulfilling
It's a
prophecy.
massive one. The computers pile in, pushing the price higher, which attracts more retail day traders, pushing it higher still.
And with a beta greater than 3.0, FJET is already inherently volatile. It's moving at least 3 times as violently as the broader market on any given day.
Yes, and when you combine that aggressive beta with the fact that there is almost zero institutional ownership in this stock, the wild intraday swings start to make perfect sense.
Because there's no anchor.
Right. You are looking at a stock with no massive mutual funds or pension funds acting as a stabilizing anchor. Institutional investors typically buy and hold massive blocks of shares, which smooths out daily volatility.
But without that institutional buffer,
Retail trading volume and those algorithmic triggers completely dictate the price action. A sudden influx of retail sentiment can send the valuation flying upward in hours, and a sudden wave of panic selling can set it crashing just as fast.
here is where it gets really interesting, though. Let's look at what actually drives that sentiment, because the business model here defies every expectation.
It really does.
When you think of a publicly traded space company, you instantly picture a massive, multi-stage vertical rocket sitting on a concrete launch pad, venting liquid oxygen.
The classic Apollo or a SpaceX visual.
Exactly. But FJET does not build vertical rockets. They operate out of NASA's Kennedy Space Center using a legacy fleet of supersonic F-104 Starfighters.
The F-104 is a legendary Cold War-era interceptor jet. It's often referred to historically as a missile with a man in it because of its sheer speed and climb rate.
A missile with a man in it. That's incredible.
It's a beast of an aircraft.
Yeah.
And FJET is utilizing these proven legacy airframes for a completely different purpose. The core of their business model, their ultimate vision, is the Starlance H system.
And what exactly does that do?
It's a platform designed to launch microgravity payloads and conduct hypersonic technology testing directly from the air, rather than from a static vertical position on the ground.
Okay, I am trying to visualize the physics and the economics of this.
Yeah.
Is it essentially like trying to merge onto a busy highway? Like a traditional vertical rocket starts from a dead stop on the on-ramp, has to burn a tremendous amount of energy just to get up to speed and fight through the thickest part of the atmosphere.
Yes.
But FJET's air launch approach feels like merging onto that same highway when your vehicle is already doing Mach 2.
The physics of your highway analogy capture the core advantage perfectly. By carrying a payload attached to a supersonic jet and releasing it at high altitude, you bypass the densest layers of the Earth's atmosphere.
So you don't need all that fuel.
Exactly. The payload vehicle doesn't need to carry the massive, heavy, first-stage booster rockets required to get off the ground. And that translates directly into massive capital savings.
Oh, because you aren't building the pad.
Right. You don't have to spend hundreds of millions of dollars constructing and maintaining complex, highly corrosive vertical launch pads. You simply use existing runway infrastructure. Furthermore, you gain incredible operational flexibility regarding weather.
That makes total sense because if a thunderstorm rolls over Cape Canaveral, a traditional vertical rocket is completely grounded. They have to scrub the launch and just wait.
But a supersonic jet can simply take off, fly hundreds of miles away from the localized weather system, reach the optimal altitude and trajectory, and deploy the payload in clear skies. The theoretical reduction in launch delays is a massive selling point for commercial clients who are operating on strict deployment timelines.
Who are those clients, though? I want to dig into the actual market for this Starlance each system. What kind of payloads are we talking about, and why do companies need to test hypersonic technology on the back of an F-104?
The commercial applications are remarkably diverse. On the microgravity side, you have pharmaceutical companies conducting protein crystallization research and material scientists developing advanced optical fibers or alloys.
Stuff that needs zero gravity to form perfectly.
Exactly. Creating these materials without the gravity-induced convection we have on Earth yields vastly superior products. Booking space on a vertical rocket to the International Space Station is prohibitively expensive and involves years of waiting.
And FJET solves that.
FJET offers the ability to fly parabolic arcs or launch suborbital vehicles that provide a few crucial minutes of microgravity at a fraction of the cost and wait time.
And what about the hypersonic testing?
On the hypersonic testing side, defense contractors and aerospace agencies desperately need to test sensors, heat shields, and communication arrays at speeds exceeding Mach 5. Bolting a prototype sensor to an F-104 and flying it at extreme speeds is significantly cheaper than building a custom test missile from scratch just to see if a sensor melts.
It's a phenomenal narrative. I mean, you have supersonic jets, Kennedy Space Center, cutting-edge hypersonic testing, and massive potential cost savings. It is incredibly easy to see why retail investors look at that business model and throw capital at the stock.
Absolutely.
But this 16% explosion did not happen in a vacuum. We have to zoom out and look at the broader macroeconomic environment for the space sector. Does this specific breakout point to a returning appetite for risk across the entire aerospace industry?
If we connect this to the bigger picture, the market dynamics detailed in the analysis strongly suggest a sector contagion effect. We're witnessing the classic trickle-down mechanics of speculative capital.
Trickle-down capital.
Yes. To understand why money is suddenly flowing into a highly speculative microcap like FJET, you have to look upstream at the larger, more established small-cap space companies.
Ah, the Rocket Lab effect.
Precisely.
Rocket Lab, trading under RKLB, has been dominating the small-cap space headlines recently. But if Rocket Lab is succeeding with traditional vertical rocket launches, why would their success make investors more willing to gamble on a completely non-traditional fighter jet-based company like FJET?
Because Rocket Lab is providing proof of concept for the entire commercial space economy. For a long time, the public markets viewed space solely as a billionaire's hobby or a massive black hole for research and development capital.
Just burning cash.
Right. But Rocket Lab is consistently launching vertical rockets, deploying commercial satellites, and most importantly, generating tangible growing revenue. They are proving that space can be a functional, profitable business model outside of SpaceX.
Okay, so that changes the sentiment.
Drastically. Once institutional and retail investors see that validation in the larger small-cap companies, their risk appetite naturally expands. They start hunting for the next massive multiplier, The speculative capital trickles down the market capitalization ladder.
Who want the next big thing?
Exactly. Investors who feel they missed the initial explosive growth of Rocket Lab start looking for the much smaller, riskier microcaps like FJET, hoping to get in on the ground floor of the next major technological leap.
Investors are essentially looking for the air launch equivalent of Rocket Lab, which brings up the most obvious comparison in the sector, Virgin Galactic.
SBCE.
Right. Virgin Galactic also uses an air-based launch system. They use a massive custom mothership to carry a space plane up to altitude before dropping it. The market views SPCE and FJAT as technological peers, but there is a massive existential difference between the two when you look under the hood.
The difference lies entirely in their respective war chests. Virgin Galactic is heavily capitalized. They are sitting on hundreds of millions of dollars in cash reserves.
Which is crucial.
It is. Developing air launch technology and undergoing rigorous safety testing requires an astonishing amount of capital. And Virgin Galactic has the financial cushion to absorb years of cash burn while they iterate on their technology.
And FJET.
FJET operates on an incredibly tight financial runway. They do not have a massive pile of cash to fall back on, which makes their daily stock price hypersensitive to any shifts in broader sector sentiment.
So what does this all mean for the investor? We've spent the first half of this deep dive exploring the thrill of the technical breakout, the undeniable coolness of the F-104 Starfighter business model, and the favorable macroeconomic winds blowing through the space sector. Now, we have to transition from the technical hype to the fundamental reality.
The hard numbers.
We need to look at the actual balance sheet data provided in the analysis report. This is where financial gravity takes over. Let's start at the top line. Revenue.
FJET's current revenue is $0. Zero. They are entirely pre-revenue. It is vital for anyone analyzing this stock to understand that current shareholders are buying a concept, a business plan, and the promise of future commercial and defense contracts. They are not buying a currently functioning sales-generating enterprise.
They're bringing in absolutely $0, but operating a fleet of supersonic jets out of Kennedy Space Center is not cheap. When you look at the cash bleed, the numbers are stark.
They're very stark.
The financials show an operating income of negative $6.64 million and a free cash flow of negative $4.1 million. What is the practical difference between those two numbers for a company fighting to survive?
While operating income reflects the core business losses, encompassing the massive R&D costs, the salaries, and the heavy depreciation of maintaining those complex F-104 airframes, the negative $6.64 million shows the true operational cost of the endeavor.
Okay, and the free cash flow.
Free cash flow, however, is the actual, tangible cash entering and leaving the company's bank accounts. The negative $4.1 million free cash flow suggests they might be aggressively managing their immediate cash burn, perhaps by delaying payables to suppliers or capitalizing certain expenses, but the underlying reality remains.
The money is still leaving.
Millions of dollars in real cash are leaving the company every year, and nothing is coming in.
That brings us to the ticking clock. The balance sheet shows they have roughly $3.7 million in cash on hand, weighed down by $11.3 million in debt.
Yes.
If you were burning $4.1 million in free cash flow annually, and you only have $3.7 million in the bank, the math is terrifyingly simple.
Assuming they receive no immediate influx of new capital or secure a major upfront contract, they have less than 12 months of operational runway before they hit zero.
Less than a year.
And that $11.3 million debt load complicates matters significantly. A pre-revenue company carrying that level of debt is heavily burdened by interest payments, which further drains that precious $3.7 million cash pile. They're in an absolute sprint against the calendar.
Here is where the market mechanics get truly bizarre. Despite having zero revenue, negative $4.1 million in free cash flow, and less than a year of runway, that 16% stock rally pushed FJET's market capitalization to over $168 million.
Staggering.
The market is valuing a pre-revenue company with a few million in the bank at over $168 million.
It perfectly illustrates the intense premium investors are willing to pay for narrative and future potential in the commercial space sector.
I want to unpack a specific metric related to that valuation. The analysis notes that FJET currently has a PE, a price-to-earnings ratio, of negative 24.80. For someone quickly scanning a stock screener, seeing the PE ratio shift during a massive rally might look like a sign of improving health.
But it isn't.
Right, that is the PE illusion. Break down why a changing PE in this specific scenario is practically meaningless.
It's essentially a math glitch driven by hype. The price-to-earnings ratio is just a fraction of the stock price divided by the earnings per share. In FJDT's case, the earnings are sub-zero.
Right, because there's no revenue.
Exactly. When the retail trading volume pushed the stock price up 16%, the price side of the fraction skyrocketed. The resulting shift in the PE ratio is a pure mathematical artifact of the stock artificially inflating.
It just looks different on paper.
It makes the company screen differently on financial terminals, but fundamentally, nothing about the underlying business improved. They haven't sold a single payload launch. The cash flow problem remains identical. It is an illusion of financial health.
So what happens when the illusion shatters? If they are burning $4.1 million a year, have $3.7 million in the bank, and the clock runs out before they can secure a government defense contract or a commercial microgravity payload, what is their only move to keep the lights on and keep those jets fueled?
Shareholder dilution. It is the looming existential threat for any retail investor holding a pre-revenue, capital-intensive stock. When a company with FJET's balance sheet runs at a runway, they cannot simply walk into a traditional bank and secure a favorable loan.
The banks don't fund that kind of risk.
No, they don't. Their primary mechanism for raising operational capital is to issue new shares into the open market.
They print more stock.
They authorize and sell millions of new shares. This instantly dilutes the ownership percentage and the inherent value of every existing share.
Wow.
The retail momentum traders who bought in during the peak of that breakout, paying $8.46 a share, could suddenly see the value of their holdings slashed, purely so the company can generate enough cash to survive another few quarters of R&D. You are paying a premium purely for the company's survival runway.
Let's bring all of this data together and deliver the final verdict. We started today's deep dive with a specific question. Is the small cap space rally officially back, or is the 16% explosion in FJET simply a fleeting dead cat bounce?
Based on the intersection of the macroeconomic data and the technical price action, the broader momentum in the space sector is real. It is not just a dead cat bounce.
Okay.
The success of companies like Rocket Lab has genuinely shifted risk appetite, and speculative capital is actively rotating back into aerospace microcaps. The chart technicals breaking the 5-day and 50-day moving averages on massive volume confirm a textbook risk-on environment. The sector is undeniably catching bids.
Yeah.
However, for FJET specifically, the fundamentals scream caution. A macro sector rally will not fundamentally save a company with less than 12 months of cash runway.
FJET is essentially operating as a high-stakes call option on the future of the microgravity economy. If you're tracking this sector, you have to look past the seductive double-digit daily gains on the stock chart.
You really do.
You have to actively monitor the mechanics of their cash burn and their debt load. Buying shares of FJET at $7.78 is not an investment in current profitability or financial efficiency. It is a pure, unadulterated bet that their management team can finalize the Star launch technology and land a major revenue-generating contract before the bank account literally hits zero.
It's a race.
If they secure that contract, the upside, given the low institutional ownership and high beta, could be astronomical. But if they fail to secure revenue in the next few quarters, the resulting shareholder dilution will be swift and punishing.
It is the ultimate test of risk tolerance. The technology is brilliant, the narrative is captivating, but the financial gravity is immense.
Before we wrap up, I want to leave you with a final thought to mull over on your own. We've explored the thrill of algorithmic breakouts and the harsh reality of a ticking financial clock. But step back and consider the broader psychology at play.
The human element.
Right. If a company can achieve a market capitalization of over $168 million entirely on the theoretical promise of utilizing legacy supersonic fighter jets to launch payloads into microgravity while sitting at absolutely $0 in revenue, what does that reveal about the current stock market's overwhelming appetite for compelling futuristic narratives over actual hard cash flow?
It suggests that in certain sectors, the promise of tomorrow is still valued exponentially higher than the reality of today.
It's something for you to deeply consider as you watch the space sector continue to evolve. Thanks for joining us on this deep dive, and we'll catch you on the next one.
Don't forget to like, share, and subscribe for more.